Hi everybody, and welcome back to video number 7 in chapter 9. Here we were going through the Lululemon situation addition to its stores. And just for a refresher, I've left this slide up so you can reacquaint yourself with the numbers. So in this case, now we're going to look at a replacement substitution here with Instinct Enterprises. They decide to replace the pipes in its plumbing system. A plumber suggests that the company use plastic tubing in place of cast iron pipes and copper tubing. Never a good idea, by the way. The old pipe and tubing have a book value of $15,000. The cost is $150,000 less accumulated depreciation of $135,000. The plastic tubing costs $125,000. If Instinct pays $125,000 for the new tubing after exchanging the old tubing, what entry would you make to record this replacement? So I think this one's a little more straightforward. Here, we're going to take the $125,000 the plastic tubing costs. We'll record that as an asset. The $135,000 of accumulated depreciation on the old pipe, we'll take that out, as well as the $150,000 here for the old plumbing system assets. And we're going to pay this $125,000 in cash here. So that means we're going to take a loss of $15,000 on this transaction. Okay, so if we refer to the facts in the example we just went through, if Instinct decides to capitalize the cost of the new asset and ignore the book value of the old asset, what entry would it make? Well, that's an easy one. We're just going to debit plant assets for $125,000 and credit cash. And that $125,000 is here. And we paid cash if we did it the substitution approach too. Okay, so summary of the costs, rearrangement and reinstallation. So if the original installation cost is known, we'll account for the cost of the rearrangement / reinstallation as a replacement. Carrying value is known. Now, bravo here if it is unknown, the installation cost, and rearrangement reinstallation cost is material in amount and benefits future periods, we'll capitalize it. Under Charlie, if the original installation cost is unknown and the rearrangement / reinstallation cost is not material or the future benefit is questionable, will expense the cost when incurred. Pretty straightforward there, I think. All right, let's look at Leonard Company. It has an existing factory that it intends to demolish and redevelop. During the redevelopment period, the company will move its production facilities to another temporary site. The following costs will be incurred for the project. 1. Rent of $500,000 for the temporary site. 2. Removal costs of $300,000 to transport the machinery from the old location to the temporary location. And 3. $1 million to install the machinery in the temporary location. Question: can all of these costs be capitalized as part of the cost of the new building? And no is the solution. All of these costs cannot be capitalized. Even though the costs are incremental, they are not directly attributable to the new building and not necessary for it to be capable of operating in the manner intended by management. The cost related to the temporary facility should be expensed as incurred. All right, Summary of repairs. That's an easy one. Alpha, ordinary repairs are expensed. If it's a major repair under Bravo, we treat it as an addition, an improvement, or a replacement. Planned maintenance. Let's look at Southwest Airlines. They're going to schedule major overhauls of its planes every 3 years. These are very expensive overhauls. I'm a pilot and I know. How should Southwest account for these overhaul costs? Once Southwest incurs the overhaul cost, it would record them as an asset and depreciate them over a 3-year period until the next overhaul. All right. The following transactions occurred during 2025. We're going to assume depreciation of 10% per year is charged on all machinery and 5% per year on buildings on a straight line basis with no estimated salvage value. Depreciation is charged for a full year on all fixed assets acquired during the year, and no depreciation is charged on fixed assets disposed of during the year. Okay, February 3rd, a building that cost $132,000 in 2008 is torn down to make room for a new building. The wrecking contractor was paid $5,100 and was permitted to keep all materials salvaged. April 10th, a wheel bearing breaks on a machine that cost $9,000 in 2017. The gear is replaced at a cost of $2,000. The replacement does not extend the useful life of the machine, but does make the machine more efficient. May 18th. A special base installed for a machine in 2019 when the machine was purchased has to be replaced at a cost of $5,500 because of defective workmanship on the original base. The cost of the machinery was $14,200 in 2019. The cost of the base was $3,500, and this amount was charged to the machinery account in 2019. And then finally, on June 5th, one of the buildings is repainted at a cost of $6,900. It had not been painted since it was constructed in 2021. What do these journal entries look like? These are very good illustrative examples. Let's look at the first one. Here, let's go back, make sure. Here, this is where we tore down the building, and the contractor was paid $5,100. So, if we tore down the building, accumulated depreciation was $112,200. We get that by taking 5% times $132,000. That's the amount per year. We had 17 years at $6,600 per year. That gives us our accumulated depreciation on the buildings. We're going to make the building asset go away. We're going to pay $5,100 more in cash, and that means that our $24,900 will represent the loss on the disposal of the building. Then on April 10th, that's an easy one, we are going to capitalize that $2,000 because the replacement was treated as a capital expenditure that made the machine more efficient. Then on May 18th, this replacement is being accounted for using the substitution approach. So we'll put the new machine in, take the old accumulated depreciation out for $2,100. And again, that was calculated by taking 10% times $3,500. So that's $350 per period, and $350 times 6 years, $2,100. We're going to put the new machine in. I should say, we're going to take the old machine out, I should say. for $3,500 and pay an additional $5,500 in cash. And that means we had a $1,400 loss on the disposal of that machinery. And lastly, on June 5th, this was a simple maintenance and repairs expense for $6,900. And we're good, and we'll just simply take that to the income statement, and repainting is considered ordinary maintenance. Okay, let's take a look at describing the accounting treatment for the disposal of PP&E. Here, a company may retire plant assets voluntarily or dispose of them by a sale, an exchange, even an involuntary conversion, or an abandonment. Always remember in the problems, please remember in the problems, depreciation must be taken up to the date of the disposition, and then we dispose of it. So here, the Barrett Company recorded depreciation on a machine costing $18,000 for 9 years at a rate of $1,200 per year. It sells the machine in the middle of the 10th year for $7,000. What entry would you make to record this transaction? Okay, first of all, we're going to bring the depreciation up to speed. We'll debit depreciation expense and credit accumulated depreciation on the machinery for $600. And that's our normal depreciation rate of $800 depreciated through the middle of the 10th year, so half of $1,200. Then we're going to record the sale of the asset. We're going to get $7,000 in cash, which we had here. And the machinery is going to go away for $18,000. Accumulated depreciation is going to go away on the old machine, plus that $600 that we did for the half year. And then that's going to result in a $400 gain in this situation. Okay. And we could look at it a little differently because the machinery is sold for $7,000 and our book value was $6,600. That's another way of backing into the gain on this transaction. All right, sometimes we might have an involuntary conversion. Sometimes an asset's service is terminated through some type of involuntary conversion. Fire, flood, theft, war, earthquake, all sorts of things, or condemnation. So we're going to report the difference between the amount recovered from, say, insurance recovery, if any, and the asset's book value as a gain or loss. We'll treat the gain or loss like any other type of disposition. And 3, we'll report the gain or loss as other revenues and gains or other expenses and losses in the income statement. Okay, so if we look at this, Camel Transport Corporation had to sell a plant located on the company property that's directly in the way of an interstate highway. For a number of years, the state had sought to purchase the land on which the plant stood, but the company resisted. The state ultimately exercised the right of eminent domain, which courts upheld. In settlement, Camel received $500,000, which substantially exceeded the $200,000 book value of the plant and the land. And that cost $400,000 less accumulated depreciation of $200,000. How would you record this involuntary conversion? So we get $500,000 in cash. We have accumulated depreciation, which we will get rid of. We'll add the $400,000 and the gain on the assets. Cash received, $500. This is how we get the gain, $500,000. We have a $200,000 accumulated depreciation, and that gives us $300,000. That looks like a good place for us to stop this video. And when we return, we will take a look at describing the accounting for contributions. Until that time, bye for now.